How do we fix recessions? And what causes recessions to happen? That's the purpose of this video, discussing this within the context of a simple short-run macroeconomic model. Recessions are irregular and unpredictable. This graph shows us the year an expansion began and the length of the expansion. A longer expansion is a good thing. That's the period between recessions. We find some expansions last 3 or 4 years, while others, like in the 90s or in the 2010s, lasted a decade. Recessions and expansions have improved since economists started studying them. Between 1854 and 1919, the average expansion was only 2.2 years, meaning you were seeing a recession every third year. And likewise, during that period, the average recession length was 1.8 years. So it was almost 2 years good, 2 years bad. In the interwar period between 1919 and 1945, which included the Great Depression, the average expansion length increased slightly to 2.9 years, and the duration of a recession shrunk from 1.8 to 1.5 years. In the years since the Second World War II, the average expansion length is now 5 years. On average, we go 5 years without a recession. And when we do experience a recession, it now lasts for less than a year. We still have a lot to learn as macroeconomic scientists about recessions and how to prevent them, but we must acknowledge the tremendous progress we have made along the way. As we have discussed before, the central bank influences interest rates to help us fight recessions, but arguably, we have other more powerful tools that come from Congress. We call this fiscal policy. The federal government can increase economic activity via direct increased spending, that is, increasing the government expenditures in C plus I plus G plus NX, which by definition increases GDP. But they can also cut taxes, which will indirectly increase consumption and investment by increasing the total take-home disposable income by households and firms. And we're going to walk through how this happens. Remember our circular flow of the economy? Households consume goods and services from firms who end up paying their workers in the form of income, and then households can either consume or save that income. The savings goes into the financial sector. Well, we can add government into the economy. They buy goods and services. They also tax households and give transfers to households. Firms invest. We have the rest of the world. And GDP is C plus I plus G plus NX. Okay. Say the government increases stimulus spending. That could either be through a direct check to the household, that'll show up in the transfers part, or they can start a new project such as infrastructure spending, which will increase government expenditures. That money filters its way into the goods or services market, but it doesn't just stay there. It goes to the firms, and the firms end up paying their workers. Now, the workers who live in households can choose between savings and consumption. So where does that spending initially go? That same money goes back into goods or services, back to firms, back to income, back to households. They save, they consume, then the cycle starts over again. The money goes around ad infinitum. A stimulus shock to the spending doesn't increase total GDP by infinity. There was that leakage at every part. A household can save, and every time they save, they're not consuming, and the money slows down how much it goes around and around. We do a little bit of math, and we can extend out how much in finite amount it increases the economy, and we call this the multiplier. That initial spending circulates depending on the initial savings and consumption decisions of the households, and so we get that total change in GDP is equal to that initial change in spending times the multiplier. How big is the multiplier? A multiplier is usually less than 2. So here's a little secret. Sometimes a city wants to build a stadium, and so they hire some folks to calculate the multiplier building the stadium, and then they'll come down and they'll say that the multiplier is like 10 or something. Somebody's lying. So if you ever see a multiplier bigger than 2, that's really not what we find in the data. And sometimes, like during these really big recessions, some of these spending multipliers really shrink down because people are scared and they save a whole lot. So a short-term multiplier could be very close to 1. Fiscal stimulus is a counter-cyclical measure. What we mean by this is it goes up when GDP goes down. So things like private investment are pro-cyclical. When GDP is doing well, people are investing. And when GDP does bad, people slow down. So one of the roles of the government to help counteract the forces of a private recession is to be that counter-cyclical force. When the private economy contracts, the public government economy steps in to counteract and rebalance the economy. Let's go over some of the ways that they do this, some specific types of stimulus. My favorite, and I think one of the most effective, is expanded unemployment insurance. So we have unemployment insurance always, but during very serious recessions, we have found it very effective to also expand the size and generosity of the check, thus mitigating the financial hardship during the recession. We also find it useful to elongate the duration. So unemployment insurance is always temporary and it only lasts a certain amount of time. You have to find a job by the end of that. But during a recession, it's very hard to find a job. And we want to make sure that people are matched with the best job. So elongating the duration is an excellent way to get money flowing into the economy and targeting the people that need it the most. And finally, you can expand who is eligible. Normally, folks who are self-employed, for example, are not eligible for unemployment insurance. The idea is that if you're self-employed, you can always choose to lay yourself off and then collect unemployment insurance. We don't want to incentivize that. However, again, during a major recession, this is not an issue. Lots of folks are struggling because of the macroeconomic conditions, not because of their personal choices. Additionally, stimulus for unemployment insurance is very stimulative because these folks need it. They are not saving it. They are spending it simply to pay for their regular budget. We also use direct payments, just sending checks out to everybody. One of the downsides to unemployment insurance is it requires a whole bureaucracy to maintain it and manage it. That could take time. There could be delays and people might need the money now. Use business grants, giving businesses a quick check so they can stay operating and functioning. During COVID, we expanded the child tax credit and for a period made the payments monthly rather than annual right after you file your taxes. In general, tax breaks are fairly common. In 2009, the payroll tax was cut in half temporarily for 2 years. Also during the housing crisis, we had this first-time home buyer credit, which yours truly took advantage of. They also tried this cash for clunkers program, so the demand for cars went down in 2009. And so kind of as an environmental measure, they said if you bring in your clunker, we'll give you a tax credit, and then you turn around and buy a newer vehicle. Some of these stimulus measures are more effective than others. But in terms of size, it's worth going over how big the COVID stimulus program was. So those direct checks there at the bottom were nearly $1 trillion. The business loan forgiveness program was also around $1 trillion. Unemployment insurance was around $700 billion. We also had the federal government support state and local governments because state and local governments cannot take out loans at the same level. They cannot engage in deficit spending. We had major funding for public health. This is what helped fund the vaccine and also provided support for hospitals. There was education stabilization, SNAP expansion, Corona Relief Fund, and a whole host of other stimulus payments for a total of over $4.5 trillion spread out over 2 years. Notice I did not include bailouts here. In the financial crisis of 2009, the bailouts were controversial, but let's talk about the details of them. First and foremost, bailouts are not free money. Unlike all that stimulus payment, that $4.5 trillion during COVID, that's just cash. Those direct payments to households, cash. Unemployment insurance, cash. You don't have to pay it back. A bailout is a loan. It must be paid back. The journalist publication ProPublica has tracked the bailouts from the financial crisis a decade ago. Around $630 billion was given as a bailout, so banks received $250 billion in loans. Fannie and Freddie Mac, which were these quasi-government mortgage companies, received $190 billion. Auto companies received $80 billion in loans. AIG very famously was bailed out with a $70 billion loan. Well, what was the result? The money got paid back. Not only was it paid back, but it was paid back with interest. Look down there at the bottom. See that $109 billion profit? The federal government gave out loans to businesses who were otherwise fairly good. They had decent collateral and a quality business model. They simply were running into funding problems in the short run. The government acted as a lender of last resort, both Congress and the Fed, lending out lots of money, always checking to make sure there was quality collateral on the other side to back up these loans, and in the end, the government made a profit, a substantial profit. So I think this is very important in the discourse. When we talk about the government bailing out Wall Street but not bailing out Main Street, remember the money used to bail out Wall Street was a loan, often a high interest loan that had to be paid back, and the government made a profit from this decision. In other words, it was not a long-term cost for taxpayers. Taxpayers made money off of these loans. However, that criticism in 08-09 was based off of significant economic suffering. One indicator of our functioning democracy is that the next time this happened in 2020, Congress learned the lesson and provided extraordinary recession relief to households during this major recession. As you can see, the total payment to families towers above anything seen before. Instead of $108 billion in 2008, in 2020 and 2021, there was over $900 billion, most of which were the direct checks, noted as the economic impact payment, as well as the expanded child tax credit of $93 billion. What was the result of these payments? the macroeconomy recovered fast. This graph shows the percentage change of employment from the peak. We have recessions going back to the early 80s. We have the 91 recession, the dot-com 01 recession, and then the housing recession of 08. We can see before the 08 recession was the deepest, total employment shrunk by 6 to 8%, but it also took 5 years before we had the same number of jobs that we had before. The 2020 recession was far more steep. Everything was shut down, folks stopped going out to spend, everyone stayed home. The employment dropped by 15%, but then steeply recovered. Why? Because the government fiscal stimulus response was simply extraordinary. It didn't have to be this way. There is no guarantee of macroeconomic success. We should learn from these lessons to help prevent economic suffering in the future.